Most founders get told no, again and again. It's frustrating, especially when you feel like you've done everything right. You've given your life to this idea and now you're out pitching investors, hoping to raise your first round, and still, crickets. Today, I want to break down exactly why that happens, not just surface level advice, but real insights from what I've seen, including a bonus section at the end with very personal advice. Let's get into it. I have a background in private equity, spent some time as an operator, and now I'm an investor at Ice Cube Ventures. We focus on early stage tech with a focus on deep tech and life sciences. Throughout my career, I've been evaluating pitches and helping companies improve on their strategy, etc. As soon as you're involved with a company, you're on their side for future pitches. That's why this topic hits home for me, because I've seen both sides of that conversation. So what I want to share with you now is not theory, it's real. It's what I've experienced with companies and what I look for as an investor. Reason number one, rookie mistakes, learnable and common. The first reason most founders here know is because of simple but costly mistakes. And I get it. When you're in the early days of your startup, you're juggling everything, product, hiring, marketing, but fundraising is its own craft. And when you don't respect that, it shows. I've seen this up close. Cold emails with no personalization, automated messages that you know will be ignored, decks sent to investors who clearly don't invest in that category, people pitching pre-revenue ideas to later stage VCs. None of these are terrible businesses, but they're not setting themselves up to be taken seriously, missing important cues on context and timing. If you want an investor to really engage, you have to research who they are and what they invest in. Reach out in a way that feels intentional. A warm intro is always best. And time it right. Don't pitch during summer break or a market crash. It's about doing your homework. It may be basic, but it's so important. Reason number two, character. This is about you, not just the idea. This part is harder to talk about, but it's real. Investors don't just back startups, they back people. Are you someone they can trust? Can they see themselves working with you for the next 5-10 years? I've seen founders act overly guarded, like they're afraid to share their idea. Others show up with ego, overconfidence, or on the flip side, total insecurity. There are so many stories. I once witnessed a full 180-degree turn mid-pitch when I pushed a little on the idea. Yeah, it's great to be able to pivot, but maybe not in the first meeting. The truth is, your character matters. Your presence matters. Investors are imagining what it would be like to work with you over the long term. So here's what helps. Be transparent. Forget NDAs. Everything is in the execution. So if you're scared I could steal your idea from a few conversations, you better check your willingness to put in the work. Answer questions directly and show that you are thinking clearly about the product and the business. Be yourself, but be aware. I mean, this goes without saying. And lastly, show humility without underplaying your ambition. It's not about being perfect. It's about being someone you can trust. It's a people's business at the end of the day. Reason number three, fit. Know why you're talking to them. Here's something that some founders overlook. VCs are people too. They want to feel chosen. So if you're pitching someone and you can't explain why they matter to you, it feels transactional. Like they're just another name on your list. I've been in rooms where the pitch was technically good, but there was zero connection. The founder didn't know our thesis, didn't understand how we could actually help them. The relationship between a founder and an investor often lasts longer than marriage. And I don't mean that in a bad way. Like often the same investor will back the same founder. So you want it to feel like a good fit, not just financially, but also personally. Talk about why this fund, why this partner specifically. How do you see them helping beyond money? What kind of relationship are you hoping to build? Even at pitch events with many investors in the room, my advice is to pick one or two investors that you want to have on board and then tailor your speech to reach exactly those people, even though the room may be filled. Reason number 4, business fundamentals. The fourth reason that investors say no is simple. The business doesn't make sense yet. There is a fine line talking about the product versus talking about the business, but investors need to know about the business. How will it grow? Is the market big enough? Are you actually looking at the correct market? Is that really where you want to play? Is your approach actually different? Why will you specifically succeed at this? And can this take off? I've passed on seemingly great products simply because the founder couldn't explain the business model. Sometimes they don't think about a clear pricing model or customer acquisition strategy, or they project huge revenue without explaining how they get there. Of course, we come in to help with many of these questions, but we need to see the basics and an understanding of these basics. Clear market sizing, where do you want to play, evidence of demand, even small wins, and unit economics that make sense and that are realistic. A founder who's honest about what they know and about what they don't know. It comes down to know what you know and know what you don't know. When you show that, investors listen differently. Reason 5, structure and admin. Small things that block big deals. This part might seem boring, but you would be surprised where problems arise because of it. You can be a great founder with a brilliant idea and still lose out because of structural stuff. How did you incorporate? How did you divide the equity among your co-founders? Did you include all these important details in your deck, or will they pop up during due diligence and everyone's like, what's that? It's not personal, it's a legal thing. If you make it hard for investors to evaluate the idea, they won't. They'll just move on. Okay, now to my bonus reason, valuation. Know what you're worth, but be realistic. Valuation is one of the most misunderstood parts of fundraising. Too low and you risk giving away too much too early. Too high, you scare off investors who know you can't justify that valuation yet. I've seen pre-revenue founders come in at 60 million valuations. That might fly in some markets, but for most investors, it's an immediate no. Most founders either go too low, where they give away too much of their company too early, or they go way too high without anything to back it up. Neither works. Investors aren't looking for a bargain. They're looking for something that makes sense. If you're not sure about your valuation, have an open conversation and see where it goes. Good investors know that in order for this to work, the founders need to keep a big chunk of the equity. Even if you do everything right, you still might hear no. That doesn't mean you failed. It just means that this investor wasn't the one. Sometimes it's timing, sometimes it's strategy, sometimes it's just not the right fit. So what do? First of all, you most probably won't hear a no during the meeting. So make sure you get specific feedback right there and then, even if it all sounds positive. Investors want to keep optionality so they won't shut the door in your face. That's why you have to make sure you get immediate and specific feedback. What makes them excited about the idea? Does this fit with their investment thesis? What will the investment committee want to look at specifically? What else are they looking for in a pitch like this? All this is a learning opportunity. At the end of the day, it's a two-way conversation. So treat it as one. Keep building, and if your company becomes strong enough, one of two things will happen. They'll come back around, or you won't need them anymore. Either way, you're in control, and that's what's most important. This strategy works well when you have a direct conversation with an investor, one-on-one, or in a small conference room. But what if you're attending a pitch event and have to present in front of a large group of people who will give you no immediate feedback? I've interviewed founders and investors at Icecubator Labs Pitch Day in Zug, and you can learn directly from them by watching this video here.